All right, it is 1:01 Central Time. So we're going to go ahead and get started. I know there may be a few people trickling in still, but we're going to go ahead and begin. Good afternoon and welcome to today's webinar, Social Security in 2022. My name is Lauren Laverla and I'm the Director of Communications here at Covisum. I'm joined today by our speaker, Joe Elsasser. Joe is a certified financial planner and the founder and president of Covisum. Under his leadership, Covisum has developed a variety of groundbreaking financial planning tools, including Social Security Timing, which was the first patented Social Security Optimizer, Tax Clarity, Smart Risk, and Income Insight. Joe co-authored Social Security Essentials, Smart Ways to Boost Your Retirement Income, and is a regular contributor for USA Today, Investment News, Retirement Daily, CNBC, and Think Advisor. Joe also maintains a financial planning practice in Omaha, Nebraska, doing the very things he'll talk about today. Our topic today is Social Security in 2022. You should see a button labeled Q&A, and if you have a question, please type it in the box and we will address your questions at the end of the presentation. Just a reminder, we will be recording today's presentation and you'll receive a link to the recording in your inbox later today. Thank you for attending, and I'll turn it over to Joe.
Thanks so much, Lauren, and thanks for everybody who's on the call today. You know, I'm quite certain that of the several hundred people that are on the webinar, you've all heard a Social Security seminar about why someone should delay benefits or why they should claim early, why they might want to coordinate strategies among a married couple, why they might want to think about different things for divorced individuals. Today's topic is a little bit different in that the last few years for Social Security have really started to shine some light on the financial challenges that Social Security faces going forward. And if you look to a few of the indicators from last year's trustees report that we'll talk about through the course of the session today, and also what's happening economically right now, we might be having some very different conversations in 2022 and beyond. And those conversations, that's our goal for today, is let's equip you to have those conversations. Let's equip you to help your clients make the best decisions for their given situations, but also address the fears that will inevitably come up as we get more and more headlines. So with that said, we'll start with Social Security in 2022 and beyond. Of course, you know, we're not representatives of Social Security, et cetera. You've got the disclosure. This is the practical aspects. This is paying attention to the system because we have for over a decade. Lauren mentioned being the first patented Social Security optimizer out in the marketplace. And this is also our own experience and other advisors who use the software's experience in talking to clients. So really, my hope is that it's a very practical webinar today. So our agenda for today, we're going to talk a good bit about solvency. In fact, somewhere in the neighborhood of 2/3 of the presentation is based around the solvency of the Social Security system and the conversations we're going to need to be prepared to have in 2022 and beyond. So we'll talk about the funding mechanisms for the Social Security program. We'll talk about some of the changes that have occurred through history. We'll talk about some of the potential changes. Now, what I won't do is jump right into any of the pending legislation, because realistically, what we eventually see is probably not any of the bills that have been introduced so far. And fourth, we'll close with, let's make it really practical. Let's dive into a typical client, do the Social Security analysis first, and then zoom into the broader retirement income challenge. That, of course, is where we as advisors live. That's where we want to focus. But being able to have the conversation to get the client to that point with a reasonable level of confidence is going to be just so important going forward. So let's start with those funding mechanisms. It used to be, you know, we started doing this 10, 11, 12 years ago. The beginning of every seminar started with this question: will Social Security be there? And the way we answered that question was always based on the most recent Social Security Trustees report. And this is the chart that updates every single year from the Trustees report. This year's, so the most recent came out in August of 2021, and it suggested that the Old Age and Survivors Insurance Trust Fund will be depleted 1 year sooner. So we'll talk about that. But what we see right now is, rather than it being 20 and 25 years away from our clients from the time they're making the decision, it's much closer. Here we're in 2022, and we're really looking at somewhere in the neighborhood of 10, 11, 12 years until Social Security is broke. And I hesitate to say that, but frankly, that's the headline. Whenever we get a new trustees report, you never hear Social Security is the trust funds are being depleted. And after that, 76 to 77% of benefits, 76, 78% of benefits will continue to be payable. Instead, you hear the headline, Social Security is broke. And that causes our clients, that causes our potential clients to make decisions that often are not in their best interest. So the last year was really interesting also at the Social Security Administration because for the first time, a Social Security Commissioner, Andrew Saul, was fired. That was back on July 9th. And then, and this was under pressure, Deputy Commissioner David Black resigned. And the trustees report actually was delayed until August 31st. If you're not deep down in the weeds, you may not have noticed that, but it was actually the latest trustees report in the history of the program. And why is that significant? There is no telling. We used to have, and the law requires actually that we have two public trustees, basically independent trustees on the Social Security Trustees, and we don't. We haven't for over a decade. So we don't have a lot of outside insights, let's call it that, to why we experienced such a delay, why we had to incorporate some of the results of the pandemic when in past years they might have punted those. But there were a few projections that are really interesting. So the trustees projected a COLA of 3.06 for 2021, which would have been applied in 2022. And of course, we know that came back at 5.9. Even at the time that projection came out, inflation was running considerably higher. And then the trustees' projection had the cost of living adjustment returning to 2.4% thereafter. Now, of course, we've all heard this phrase, transitory inflation. I don't know that anybody right now is believing that this inflation is transitory, at least that it'll be over in 2, 3, 4, or 5 months. So these projections are really interesting because as we come into a next year, typically we get a Social Security trustees report sometime March, April, May. And so as we're preparing for this next trustees report, what are the things to be prepared for? Number one, it's not unlikely that we will see yet another movement of the depletion date for Social Security trust funds. That is not an unlikely scenario. One of the big reasons is that COLA applies to all beneficiaries across the board. And as a result, it immediately increases program costs. Now, that's no big deal if the other thing also happens, which is an increase in the wage index, because that effectively means that there's more wages paying into the Social Security system. And historically, the wage index has run about 2% higher than inflation has run. Last year, though, there was a dislocation between wage increase, which came in positive, which was significant, but there was a disconnect between wage index and inflation. And that disconnect is quite possibly going to be there again, which means costs go up, but revenues don't go up as fast as costs. So it's not unreasonable to think that seeing less movement here, Social Security is funded by payroll taxes, as well as tax on Social Security benefits. That makes up 93% of the program's revenues. And the other 6.8% comes from interest and withdrawals from the current trust funds. That provides about 6.8% of program revenue. So of course, when the trust fund is depleted, we'll no longer be able to draw this 6.8%. That is immediate shortfall. And then the other source of funding that you occasionally see are statutory infusions of general revenue. So when there are significant disconnects in the program, I think about the payroll tax holiday a few years ago. That was a situation where there was a payroll tax holiday where we didn't have the FICA contribution, and instead general revenue, so general tax funds, were pushed into the Social Security Trust Fund to make up the deficit. So occasionally throughout time, there have been statutory infusions of general revenue. But for the most part, Social Security is supposed to be a standalone system where dedicated taxes support the benefits. Now, this is the part that's important because, of course, if the depletion date is moved up, or if the wage index doesn't move up as fast as program expenses, specifically due to cost of living adjustments, then we might see more movement like we saw last year. So these were the key stats from the 2021 trustees report. The OAS-DI, that's old age survivors and disability insurance, that depletion date moved to 2034 from 2035. And after that point, 78% of benefits are still expected to be payable by then current tax revenue. Now, the OASI, which is just the retirement benefits, that depletion date went to 2033 from 2034, and 76% of benefits are payable at that point. Now, historically, Congress has authorized movement back and forth from OAS-DI and from the DI Trust Fund and the OASI Fund. Effectively, in the past, you'd have DI with a shortfall, so retirement funds were used to support the Disability Trust Fund. But it takes congressional action for that to happen. So if we happen to be in a situation where we don't have lawmakers that can pass laws, then really this date is the date that matters to our clients, 2033. Now, if we were just to solve this problem right away, Congress all got together and said, you know what, we just need to increase taxes. We need to solve the problem right now so that there can be certainty going forward. I'm sure that if I could hear some of you on the call, you just chuckled. I'm sure of it, but I can't hear you, so I'll put that out of mind. So if taxes were increased today, it'd be a 3.36% increase in order to fund the system. But if we wait, if taxes are increased at depletion, it takes about a 4.2% increase. And every year, this projection actually goes up. So it's important to really understand that distinction between scheduled and statutory benefits. Now, scheduled benefits are basically what the statement projects, what the current benefit formulas project would be payable. But statutory benefits are what current law says will be payable. And if you've never read the disclosures on the bottom of a Social Security statement, I highly suggest you do so, because they plainly state that in the absence of congressional action, effectively, if the law is not changed, Social Security is only allowed to pay out what is coming in. It can't go into debt. And so benefits would be cut in the absence of action by Congress to whatever is coming in at that point. So this is a scenario that we did a couple of years ago. You probably heard some of the buzz during the pandemic. Oh my gosh, we've got so many unemployed people. We're going to have tax revenues way down. We've also got people claiming because they were laid off. So you had a higher potential claim. And now we've got this potential inflation. And so, or this actual inflation and potential future inflation. So we were asked to do just kind of a case study. This was a really bad case. So this is a 62-year-old female in average health with a $2,000 monthly benefit at full retirement age. And then we modeled two scenarios: benefit cut by 24% in 2035. That really represents something very similar to what the trustees report eventually came out with. But then there was a benefit cut of 24% in 2029. And why did we do that? Some of those early reports, this was similar to the Bipartisan Policy Center. It would have been a larger percentage cut, but a depletion date in 2029. We said those are two possible scenarios. What do they actually look like? And so in each column, this is the benefit cut of 24% in 2035. You'll notice that the value of claiming at age 62 for her versus the value of claiming at age 70, by the time she reaches 85, and she has a 64% chance of reaching 85, a better than 50% chance of reaching age 85, she'll be to the good by about $36,000. The same is true, actually, for a benefit cut of 24% that happens all the way back in 2029. Now, why do I say this is one of the worst case scenarios? Because this is an individual, if she's 62 in 2020, she's actually going to collect 8 full years of early benefit she claimed early. But right after she claims her delayed benefit, she'd foregone those 8 years of checks and hit age 70, and then she immediately experiences this benefit cut. That's why this is a really bad case scenario over here. And yet by age 85, she's still in better shape having delayed. So that's the first important thing to understand, is that Social Security claiming strategies definitely are impacted if we do experience a benefit cut. They're definitely impacted. And yet for most people, claiming out of fear is not the answer. For most people, understanding the impact of the decision may be more valuable than ever, because the default, the louder the media gets about Social Security trust funds, the louder that media gets, the default is going to move more and more to claiming early. So that's the first, I guess, takeaway that I'd really love to have everyone in this meeting today, in this webinar today, internalize. And that is that the gut reaction, the more media that we hear that Social Security is going broke, the gut reaction for our clients is to want to claim early and get it while it's there. And for most people, that is not going to be the optimal choice. Now, that said, we also need to be prepared to have a conversation about what might the world look like. Now, what we won't do is talk about any of the acts that are out there. I've seen, and maybe it's just because I subscribe to an awful lot of different feeds, but I've seen an awful lot about the Social Security 2100 Act. And I'm not going to talk about the Social Security 2100 Act, even though it's got a lot of co-sponsors. They happen to all be Democrats, and the likelihood of this passing is next to nothing. We may end up seeing parts of it incorporated, but instead what we'd like to do is take a little bit of a look at history. 1983 was a really significant year for Social Security because the system was on the verge of going broke. And we really needed to reach a conclusion, changes that would put the system on solid footing. And so understanding a little bit about that history, and then also understanding some of the potential changes that are out there, will equip you to have conversations with clients that are not just, yep, benefits will be cut, because most likely benefits will not be cut for everyone equally. Some people may experience a benefit cut. Other people may experience actually a benefit increase, believe it or not. So we'll talk about some of these different policy provisions so that you're equipped to have conversations with clients about how it may impact them specifically. So 1983, as I mentioned, was an interesting year. And the 1983 reforms really included a variety of things. They did include some benefit cuts. They also included some additional taxes, and they included some benefit increases. So we'll talk about those a little bit here. Now, the first benefit cuts was the WEP, the windfall elimination provision. So the windfall elimination provision applied to individuals who worked in non-covered employment. So for example, California teachers. We just see a ton of those put through our system. And so California teachers don't pay into Social Security, but as a result, they have a much higher pension benefit. Before 1983, they could collect both a full Social Security benefit and their full pension benefit from the state if they also had at least 10 years of work in the Social Security system. So windfall elimination provision reduced that benefit and kept them from being treated as a low-income worker. It also went the other way for GPO. So in 1978, the government pension offset actually eliminated 100% of spousal benefits and survivor benefits for someone who receives a pension from non-covered employment. So this actually represented a benefit increase, that GPO movement. It also increased full retirement age from 65 to 67. Now we're seeing that still phased in. We're at the tail end of that. But if you just think about that, gosh, we're at the tail end. It is 40 years later. That move in full retirement age took 40 years to phase in. So whenever we talk about significant shifts in the Social Security system, we've got to be aware that one of the primary goals is stability. And if stability is one of the primary goals, then we'll often see things phased in or smaller changes that become bigger changes over time. So the second of the 1983 reforms was tax increases. So it accelerated the increase from 5.4% for the payroll tax up to 6.2% with a general revenue offset. And what I mean by that is we mentioned that sometimes there is just not enough money to do a thing today. And so when those are the situations, you'll often see alongside it a general revenue offset where other taxes are pushed to the Social Security system to overcome a short-term problem that eventually will be solved through legislation that needs to be phased in. So that was the first tax increase, was it increased this, accelerated an already planned tax increase from 5.4 to 6.2 and did it right away, and then did some general revenue offsets to provide tax credits against that. The second was prior to 1983, Social Security benefits came through tax-free. 1983 created that first tier of benefit taxation. And you can effectively think of that as kind of a means test. So someone who has only Social Security on their return is not going to pay any tax on their Social Security benefits. But as soon as you have other income, you have the potential to have up to 50% then, and then again in 1990, the change brought it up to 85% of potential benefits as taxable as ordinary income. Now, there were some changes that actually increased benefits. Prior to 1983, the COLA was not automatic. Prior to 1983, it actually took congressional action to apply a cost of living adjustment. There were also increases for widows and disabled widows. So the idea of equity, of, what the program goals are to effectively keep elderly people out of poverty. And that was an area that really needed some specific reform. And finally, it also broadened coverage. So if you've been in this business a while, you've probably had retirees under the old CSRS system, CSRS, which then moved to the federal employee retirement system. So after the 1983 reforms, there was a transition away from the two separate benefit systems, with everybody then being involved in the Social Security system, and then also employees of nonprofits. So what you'll tend to see, and what we should expect, is some blend of different legislation. Now, this is a really excellent summary that every year Social Security actually updates. And there's a short address for it. It's just ssa.gov/solvency, and it's going to get you to this page. It's about 38 pages. So, this is before bedtime reading if you're this kind of a person. But it goes into a lot of detail of the different policy provisions and how much of an impact that would actually have on the deficit, on how much Social Security will be able to pay out relative to program revenues. So there are a broad category of reform proposals. And in the next 20 minutes or so, I'm going to walk you through a few of each of those proposals so that you'll have some idea of how broad the potential changes are and how to communicate some of those with clients. So first, of course, there are COLA provisions. Now, with any of these changes, by the way, we're going to score them. This is how Social Security actuaries score them. But it doesn't mean you can just block them together, add this one, this one, this one, this one together, and you have a solution. Sometimes they interplay off each other. So that's something that's important to note about each one of these. So the first is the potential COLA change. We've been calling this for years. We've been saying this is highly likely to happen. And we were really thinking after the Tax Cuts and Jobs Act came out and switched over to using chained CPI as the measure for how tax brackets moved, we really expected this to happen kind of in short order. It still hasn't happened, but this is a change that we do expect will happen. Changing the cost of living adjustment from CPI-W to chained CPI. And the difference there is that chained CPI recognizes changes in purchasing behavior. So, effectively, if there's a drought in Florida and the price of orange juice goes way up, people are likely to switch to apple juice or some other substitute good or service. So chained CPI represents changes in buying patterns that are linked to changes in prices. So it's a lower measure. On average, it's about 0.2% per year that benefits that would be a lower cost of living adjustment per year. Now this 18% over here, you notice it's in green. Anytime we go through these, if it's in green, it saves us, it takes care of about 18% of the deficit that is expected if this change went into effect. So another change is IRMAA style phase outs for COLAs. So what you'll notice, if you look at these thresholds and you think anything about Medicare premiums, you'll notice those are the same thresholds that are used to determine whether people pay an extra Medicare premium surcharge. So one of the proposals that's out there is to say, well, for most people, let's leave Social Security COLAs as they are. But for the high wage earners who already have a higher Social Security benefit than everyone else, let's go ahead and apply a lower cost of living adjustment. So it's not a direct benefit cut immediately. Instead, it represents a much lower increase in the amount of benefits over time for high wage earners. And it could actually eliminate those cost of living adjustments. So that change alone takes care of 43% of the deficit. Now, well, there are all sorts of different varieties of these. So I mentioned that document is 38 pages, and in the slides you see, okay, here's A9, that's the provision. Now, A7 through 11 might all be versions of this that would have different thresholds for phase out. So that's how you can use these slides to think about your own research if you decide to do so. Now, another one of the changes that we hear regularly is that Social Security benefits should not go down in terms of a cost of living adjustment. Instead, they should go up. There is this experimental index for the elderly. CPI-E is the experimental cost of living adjustment for the elderly. And that computation would actually cause COLAs to be a little bit higher than they would have been otherwise. So that would actually cost an additional about 12% of the deficit. So whenever you see a negative number in a red, it means it pulls us further from solvency. Now, this is one that we don't expect to go anywhere, primarily because so much of those costs are borne by government as opposed to being borne by the individual, meaning the individual doesn't experience the full increase that the CPI-E increases. There are also some possible benefit formula changes. Now, Social Security benefits, you may know, are based on this PIA formula, the primary insurance amount formula. And the primary insurance amount formula is designed to replace a higher percentage of a lower income worker's pre-retirement earnings than it is a higher wage earner. So if your average indexed monthly earnings are below about $1,000, 90% of that is replaced by Social Security. For AIMEs between 1,024 and 6,172, it's 32%, and above, only 15% is replaced. So the idea here is that every year these bend points move, so they go up. So every year as wages increase, so do these thresholds, which means overall Social Security benefits have historically grown in line with the increase in average wages, not the increase in prices. So if that were to be flipped on its head, and instead of Social Security benefits increasing with wage growth, they were to increase, and by Social Security benefits, I mean initial benefit amounts. If instead they were to increase based on price growth, then effectively that change alone solves 78% of the shortfall. And so there are a variety of those different proposals as well. Increasing minimum benefits. So this is effectively a provision that says, if you were in the workforce for 35, 40 years, and you were at minimum wage the whole time, but you were slugging it out, you're getting a low Social Security benefit, and it's probably not enough to replace pre-retirement earnings. And it's also probably not a situation where you had enough money coming into the household to be able to save substantially on your own. And so there is an awful lot of proposals out there about increasing benefits at the very lowest end of Social Security benefits. This is one of many proposals. You'll notice a lot of these are targeted and you don't see a huge increase. So what probably ends up happening is you see some of the bigger cuts at the high end and you see some increases in benefits at the low end. Now, here's probably what most of our clients are most afraid of, and that is means tested benefits. So the idea of reducing Social Security benefits for high wage earners. And these are two thresholds, 60,000 for single and 120,000, and then phasing in as income gets higher, Social Security benefits get lower until 50% of the Social Security benefit, I believe in this proposal, is eliminated. Surprisingly, this doesn't solve, this is not a broad-based enough thing to be able to solve the problem. So even if we saw some form of means testing, we're unlikely to see means testing by itself. Retirement age changes. I know a lot of people think, hey, it's highly likely that full retirement age continues to increase. And that's definitely a proposal that's on the table. We saw full retirement age has already moved from 65 to 67, phased in over 40 years. This is a proposal to go ahead and continue to increase it again until age 69. But then, of course, under the current structure, there would only be the ability to delay until 70. So this proposal also allows delayed retirement credits to be earned until age 72. Now, surprisingly, that's not unheard of either. Prior to 1983, it might have been 1978, but it used to be that you could earn delayed retirement credits all the way up to age 72. So it would be the same schedule as it is. This particular change, increasing full retirement age, but also giving people the ability to earn DRCs later, would solve about 28% of the challenge. Hey, what if we increased earliest eligibility? Rather than age 62, let's have it be 65, the first time you can claim Social Security benefits. You might think that would reduce program costs. It doesn't. It actually increases program costs. Now, that should tell you something about the value of delay. If raising the earliest eligibility age actually increases the cost to the system, why would that be? Well, because for most people, it's actually better to delay, and actually does cost the system more to fund those benefits. So increasing earliest eligibility is an option that's out there. The likelihood of this is probably really low unless there is a coincident like revamp of disability benefits. That might be a way to say if you're incapable of work or incapable of work similar to the work you used to perform, something of that nature, then you might be able to see those kinds of things, those kinds of reforms next to each other. What about spousal and survivor changes? Now, this is one, frankly, that I hope happens. The manner in which a lower earning spouse benefit, survivor benefit, is controlled by the election decision of the higher wage earning spouse does not make a lot of sense from a policy perspective, from a planning perspective. But at the same time, it is what it is today. Those are the rules today. And so as an advisor, if you're not always looking at a high wage earner's benefit and saying, okay, how much longer is that likely to be paid than a single life would project? If you're not asking that question, you really need to be. Effectively delaying that high wage earner's benefit is equivalent to buying a joint and survivor annuity for a single life annuity price. In other words, it's a great deal when you have a survivor that is likely to outlive that high wage earner. But at the same time, that's not the decision that's made by most people in the absence of advice. And so we see a lot of widows whose the high wage earner was not paying attention to those rules and did not make the optimal decision for the family. And so they're experiencing an unusually low benefit. And so the idea here is to increase the minimum survivor benefit, effectively make sure that that decision that the higher wage earner and the couple made doesn't horribly impact the survivor. There is a cost to it, of course. So this is kind of in parallel. Over time, there have been a variety of different alternative minimums for different benefits that have come into play and then phased out over time. So this might be a transition. That might be another possible way that they would use an alternative minimum benefit. So what are some of the payroll tax changes? I'm sure everybody was holding on just for this point. So if we just eliminated the taxable maximum, doesn't matter how much you make, you're going to pay the full 12.4%, or I guess 6.2 if you're employed, and your employer pays the other 6.2, or if you're self-employed, you get to pay both halves. So if we just eliminated the taxable maximum, it used to be, we could say that solves the problem by itself. That no longer solves the problem by itself. That takes care of about 57% of the shortfall. Now, notably, this provision says we're going to provide that full 15% bend point for all earnings that are above the current law taxable maximum. So those really high wage earners could end up having some really high Social Security benefits. Now, here's a proposal that modifies that a little bit, and it says, okay, on anything that's above the current taxable maximum, somewhere around $148,000, you're only going to get 3% of that returned as a Social Security benefit. So effectively, it becomes a really, really bad deal to pay Social Security taxes above the current taxable maximum, but you are getting something. You're getting some increase on the benefit. So this idea is incorporating it right away in 2022, and that actually takes care of about 2/3 of the funding challenge. Now, this is effectively Biden's donut hole provision. What if we taxed earnings over 400K and added a 2% bend point for earnings that are over that. That policy provision didn't end up going anywhere, but that would have solved about 61% of the overall funding challenge. So what are some other potential changes? Including health insurance premiums in earnings. So expanding covered earnings to include employer and employee premiums for employer-sponsored healthcare coverage. That alone, right now they're excluded. That alone takes care of about 34% of the deficit. Net investment income tax. This one scares me a little bit, primarily because whenever there is precedent and it's something that feels like it worked. So prior to Affordable Care Act, there was no net investment income tax. You didn't have that additional 3.8% on net investment income over certain thresholds. So the idea here would be, let's tax that additionally, an additional 6.2% tax. So all of a sudden that becomes 3.8 and 6.2. It's an additional 10%. And there's a realistic possibility that this gets looked at hard. Why? Because you think about somebody in a 15% capital gains bracket, but they're a high wage earner otherwise, they're definitely in at least a 22% ordinary income bracket. This puts the capital gains on similar footing, at least that's how it might be explained, putting the capital gains on similar footing to ordinary income. So this could be a situation where even if it's not a full 6.2%, we can expect this gets looked at because it did get looked at for Medicare. So 27% would be the impact of an additional 6.2% net investment income tax. Funny enough, 20 years ago, we heard all the time, Social Security trust funds should be invested in equities. We're really kind of past the point where that would make a difference. And the reason is we're relatively close now to depletion of the trust funds. So even if the trust funds were invested in equities in a pay-as-you-go system, you would never invest, just think about your own clients, you'd never go out and buy stocks for funds you've got to pay out this year. And in a pay-as-you-go system, that's what it would be. And so from an actuarial perspective, then an investment in equities really has no impact on the actuarial balance in total. Just a couple more, and then we're going to dive into the retirement income case study. So if they increase the threshold for taxation of Social Security benefits to $50,000 for single filers and $100,000 for joint filers, this has been proposed in a variety of different ways, just because the two-tier system, $32,000 and $44,000, that two-tier system is arguably unnecessarily complex. And yet at the same time, if we were to see thresholds go to $50,000 for single and $100,000 for joint, none of these proposals has suggested changing the provisional income formula. And that's the idea that only half the Social Security benefit goes into the formula in the first place. So if that's the case, if we did see this, we would see some really significant planning opportunities for advisors to structure which incomes are coming in at which times in order to really minimize that tax. So when we get down to what you might take away from this combination, keep in mind that's a short summary of 38 pages. It's a heavy read. It's actually an interesting read for those of you who like this stuff. But what we should take away is that the idea that we're going to actually experience a 24% benefit cut across the board, that's highly unlikely. Instead, we're likely to see some larger changes, whether they be tax increases, revenue raisers, or whether they be benefit cuts on higher wage earners. On lower wage earners, we're probably likely to see some reforms that are more likely to raise benefits. And the middle is really going to be, and for most of us, those are our clients, right? The middle is really going to be an interesting mix. And so if we think benefit cuts may be disproportionate, tax increases may be disproportionate, and we're likely to see a combination of both, then really we can think about that benefit cut as a bad case, right? This is a potential bad case. It could happen. But there is likely, and historically there's been precedent for change, and those changes might include a couple of these different things. So if that's the case, how do we actually handle this kind of planning? I mean, It's easy when that challenge is 30 years away. It's not a big deal, and it's not something that really needs to be addressed in any depth. When it's 10, 12 years away, it's going to be part of our client's decision whether or not we talk about it. So let's dive into this case study for a married couple. We've got John and Jane. John's born in 58. He's a higher wage earner. We're planning for age 87 for life expectancy for him. And we've got Jane born in 61, upper wage earner, definitely not at the highest end, but she's above average. And we're planning to 91 for her. So if we just follow a typical Social Security planning process that says, okay, when should they claim? We're going to come up with $129,000 difference. And these, by the way, for those of you who are already subscribers, these are just screenshots from the portal, the portal version of Social Security timing, if it doesn't look familiar. So that's $129,000 present value difference. In other words, like adding $129,000 to their, depending on their tax situation, either their IRA or their Roth IRA today. And it's got him delaying until 70 and she's taking at age 68. And of course, that combination results in this $129,000 difference. And you've probably all seen our break-even chart. The idea that we're going to kill each member of the couple off, hypothetically, of course, at every age between 70 and 100. And where the dot is red, that means taking early would have made the most sense in retrospect. Where the dot is blue, that means that following the suggested strategy of he delays till 70, she delays till 68 would actually work out in their favor. So you can see in this case, if they both make it to about 82, 83, then they end up having been better off with that both delay scenario. If one of them dies early, the other has to live a reasonably long time in order for that to make sense. So that's what a break-even chart looks like for a married couple. For those of you who have not experienced our software tools before, you might be used to a break-even chart that's two lines that cross each other at some point in the future. And the reason we don't do that for married couples is because if either member of the couple dies before those lines cross, then the trajectory of the line would change, and ultimately that would be wrong. And so this is a better way of representing a break-even for a married couple. Now, one of the most common strategies right now that advisors are talking about is the split strategy. Effectively, you're going to have the lower wage earner claim as soon as possible, and you're going to have the higher wage earner delay as long as possible. And the reason to do so is that higher wage earner's benefit is going to continue for as long as either member of the household is alive. It's effectively like buying a joint annuity for a single life price. And so that's the reason advisors use the split strategy. Now, does it make sense if both people are likely to live to their late 90s? No, it doesn't. But does it make sense if either member of the couple, even the high wage earner, has concerns about their longevity? It becomes a behavioral issue. Some people simply are not comfortable delaying benefits until age 70. Well, if they're not comfortable, a way that they may become comfortable delaying at least the high wage earner is by getting some cash flow into the household earlier, having the lower wage earner file early. So in this case, it doesn't quite capture all the value that the both delay strategy captures, but it captures a heck of a lot more than both of them filing early. And here's what a break-even chart looks like in that case. You can see if they both die at 70, of course, they're going to be better off having claimed early. But if either member of the household, but not both, live a reasonably long lifetime, you're going to see that green showing up here. Now, if both members of the household live a long time, the suggested strategy still works out to be the best. So in this case, you can see that in that either member of the couple lives a long time. If you just think about that intuitively, you had more Social Security money flowing into the household earlier in retirement, which means they had to spend less 401k or IRA or non-qualified money along the way. That person then passes away, or either member passes away. It just means there's more money in the household that hadn't been spent while delaying Social Security. And that's why you see if either lives a long time, but not both, split strategy ends up working out best. Now, if we apply a benefit cut to that, let's go ahead and use the OASI figures from the last trustees report. That's actually the default in Social Security timing. You click one button and it applies your stress test. Here's our 24% benefit cut. It really does represent about a $200,000 impact on strategies, a little lesser impact on claim early strategies than it does on the delay strategies. but you can still see the delay strategies tend to have still substantial impacts, positive impacts over the claim early scenarios. Now, when we apply that break-even analysis, including the benefit cut, you'll notice there are more situations in which red comes up as having been optimal, right? They've got to live a little bit longer in order for that break-even to happen. But you also see the split strategy ends up beneficial in a larger variety of cases, and the both delay strategy in a smaller number of cases. And yet 85 and 86 out here for a break-even into that both delay strategy really isn't that late. For most of our clients are, upper half of wage earners in this country lives 5.9 years on average longer than the lower half of wage earners in this country. And as a result, our clients are going to tend to have longevity that's greater than the average. So that's how you do that break even, including a potential benefit cut. So when we bring that into the overall retirement income strategy, let's just add a few assets here. So we've got John with $1 million IRA. They've got a 500K taxable account with 400K basis. Last month it was a 600K taxable account. Now it's 500. Jane's got a $500,000 IRA. Let's say they have $9,000 per month as a joint income need and $7,500 per month as a survivor income need. And we're just going to assume a 60-40 stock bond portfolio across all the accounts. So some of the techniques, you might be able to juice those techniques a little bit by doing some asset location things. We didn't do any of those in this case study, so there wouldn't be any misleading results as to what the cause can actually be attributed to. So when we think about retirement income in total, we really think in terms of three key metrics. How long does the money last? Portfolio longevity. If we run out of portfolio assets, what percentage of the client's retirement income need continues to be met by guaranteed sources, pension, Social Security, lifetime annuities, et cetera. And then the estate value, that is what's left over after taxes in present value to the people or causes we care about. And of course, we don't just care about the base case, kind of what if everything looks rosy. We want to know what happens in a variety of different situations. So each of these is a stress test. What if we get a down market? What if Social Security benefits are cut, et cetera? What we really care about is, am I okay? Does my balance increase over time or do I run out of money? And where does my money come from throughout the course of retirement? Those are two big questions that clients ask. So you can see the base case here is always what most people do in the absence of advice. They take non-qualified money early. They take Social Security as soon as possible. They use IRA money when they have to, either because they're out of non-qualified money or because they hit now age 72 and have required minimum distributions. And if they have Roth money, they use it last. In the absence of advice, research says that's what most people do. Now, if we apply a Social Security split strategy, what do we notice? There's a little bit of a change down here in the pattern. We see this little red come through. This is her Social Security benefit. And you notice his delays. So his doesn't start till 6 years later. We're using non-qualified money alongside it. Now, in that case, it doesn't have a huge positive impact. It's only about, what is that? About $30,000 of impact, a little less than 30,000. Of positive impact on the client's situation. And it doesn't solve kind of the down market stress test. So it does have a positive impact on them. And 30K today, I doubt any client that I have would walk by $30,000 of free money. But then when I add Roth conversions, I see a pretty significant difference, right? First off, when I delay Social Security benefits, I have this real window between whenever the client stops working and age 70 when they claim Social Security and 72 when they start taking required minimum distributions. Now, all of a sudden, I have a lot more latitude in how I use the client's other assets to fill that early gap. So in this case, that added by itself about $100,000. That combination of Social Security and Roth conversions. This is not investing Roth assets more aggressively. This is strictly the Social Security and tax impact of these techniques. And in this case, our Roth conversion strategy is probably the most conservative strategy you can get. We're calculating annually the amount that would be taxed at a rate less than the client would pay in the base case. So in other words, we're basically saying, first, do no harm. I don't want to pay more taxes now than I would under my base case scenario if I didn't follow anybody's advice and did what most people do. So we're doing a really conservative Roth conversion strategy here. And you can see the amounts aren't incredibly large. 60 grand for the first 2 years. Then we've got that first Social Security benefit kick in, and that kicks it down to 12 to 20. And then we see the second Social Security benefit kick in, and all of a sudden we don't do Roth conversions to any significant level any longer. Now, if we throw a benefit cut on there, we say, okay, well, what if we do all this planning? We do the Roth conversions, we do these different things. Is it worth it if we're going to get a Social Security benefit cut? And the answer is, as we started the presentation, in most cases, the client is still going to be better off following a Social Security strategy, particularly if you're stacking it with other financial planning techniques, than they're not, even under a benefit cut scenario. So this is in a benefit cut scenario. The estate value, still about a $40,000 difference, even if benefits are cut, where we really kind of chop the legs off that higher wage earner in the plan case. So when we back all that up, right, we started with Social Security does have real funding challenges. They are real, and they're not in the very short term, but they're in the short enough term that we're going to hear press. We're going to hear our clients talking about these things. So being at least reasonably literate on some of the proposed changes that are out there, and also the impact if we can't reach a conclusion, if Congress can't come together and reach a compromise in time, what does that impact look like? How does that impact our client? So if we're going to take a few things away, it's that tax increases might be disproportionate. They'll probably fall higher on higher wage earners. That was a theme you saw through those proposed changes. Benefit cuts, or at least tamping down the rate of increase in benefits, may be disproportionate, also targeted towards higher wage earners. But we're likely to see a combination of policy provisions. So how do we go about this in the real world, where we have to make decisions? We have clients who are going to retire today, tomorrow, the day after. We've got to help them make the best decisions they can. The best thing that we can suggest is to plan for the scheduled benefits, but stress test for statutory benefits. In other words, are you okay? Do you still meet your retirement income goals, even if we get a Social Security benefit cut? And if not, what can we do today? What are some smaller changes that we can do today to put you on a track where, even if some of those not so good outcomes materialize, you're still going to be in okay shape? That's the kind of conversation we're having with clients. A lot of our advisors are having with clients, and I hope we've equipped you to have that conversation today. The last bullet point is that split strategies are often that behavioral hedge. If you have the client that says, gosh, with everything that's going on, we just can't both delay benefits, split strategies are a reasonable way to overcome that behavioral challenge. So if you liked what you saw, you're not a subscriber, I think we're going to pop a poll up here on the screen. We'd really like to know how you felt about the presentation today as well. You'll get a survey after the fact that will give you the opportunity to rate us and tell me whether this information was valuable. We have historically tried not to live in the land of what could be and instead live in the land of what is. But right now, what is includes some what could be.